Welcome everyone, and very sorry for the delay. So welcome to the technical session on risk barometer in digital lending towards better consumer protection. India's fintech leading sector and, and has been growing at a rapid growth in the last 5 years. Since its initial launch, this growth has been spurred by a rapidly digitizing economy, demographics that are skewed towards a younger population segment, increase in mobile and internet penetration, low cost of internet data, investment in digital public infrastructure by the government, and a progressive regulatory and policy framework that encourage rapid innovation. The rapid growth has been accompanied by a rise in risk that affect both consumers and the financial service providers. The Reserve Bank of India's Working Group on Digital Lending and their Financial Stability Report, issued in 2022, provided warnings about the risk posed by digital lending to consumers, the financial sector, and the economy at large. While media reports on emerging risks have served to provide a spotlight, these can only be dismissed as anecdotal. A systematic study that shows how these risks are perceived by various market players needed to be done. The FinTech Association for Consumer Empowerment and Industry Association of FinTech Leaders in India partnered with the Center for Financial Inclusion at Axion to conduct a survey that identified and prioritized the risks that affect FinTech lending in India today. In-depth interviews were conducted with the select respondents to arrive at a nuanced view of these risks, and this report is being released today, followed by a panel discussion. For this, I would like to invite Mr. Avtar Monga, Independent Director on Board of FinTech Association for Consumer Empowerment, to release the report formally. Mr. Monga is an experienced professional with a career spanning 3 decades in banking and financial services. He was the former CEO of IDFC Bank and Managing Director, Global Delivery Center of Expertise, Bank of America. So the report. So I would invite you to say a few words.
Well, thank you. That was very, long and great introduction. It's a pleasure to be here. My name is Avtar Monga. As she said, I have been associated with the banking industry and also the global back office at Bank of America. And more recently, I have actually been very directly involved in putting together what is now called the IDFC First Bank. And I must admit one thing, that period which, we just saw, about 7-8 years in the past, were the most rewarding in terms of how the industry is not just the banks, but also a lot of other entities and models which emerged. So I'll not take any long because I think panel is more important. But my observation are that in the last 8 to 10 years, the technology-led innovation has actually multiplied in the country, which has created a lot of good news, which is the opportunity. And it actually is helping the overall dream of us having a country where the credit is available to all. That's the long-term, vision. But if you look at the progress in the last 7-8 years, few things have happened which are very, very, visible. When you talk about the financial institutions, there have been new models of new financial institutions, whether it's the small finance bank or the payment banks and other things. When you talk about lending, the whole new world of lending emerged because the national infrastructure put together by the government of India, particularly with the help of India Spirit and all, has created railroads for lending to go beyond the branch banking of the banks in the past. So there are at least thousands of fintechs which have emerged, and parallelly, apart from the starting to have new business models which have also emerged. There were never any models called P2P about 10 years ago. There were no models called, joint lending. There were no, PPIs in the world, and all those things have been evolving. So on one hand, a lot of companies have come together. The other hand, a lot of processes have been put in place, a lot of national infrastructure, and all this has led to a great amount of expansion of credit, but it's still a long way to go. Now, when this happens, obviously, there are other things which happen. Similar to this, the regulatory environment also has been emerging. There are new guidelines, whether it's the digital lending guidelines, there are new certifications, there are no requirements. And in addition to all this, when you're talking about expanding the technology, it also brings the technology risk associated with the technology, which is the cyber risk. So many of these things have been in the parallel sort of space. But the good news is, overall, this is what is required to happen as a country for us to have everybody get to that point where everybody who needs credit has access to credit. It's a still long way to go, but there's a lot of progress. So one of the things which we wanted to actually gauge was, how is it this risk in terms of perception of it being viewed by multiple stakeholders. Now, the fact is, this study focuses largely on the lending fintechs, as well as some of the support partners which are supporting these fintechs to gain market share. So this is not going to cover the regulatory view of the risk, which we can probably have an offline discussion about, but this is what the study is all about. So it's a pleasure to have the study launched today, and I'm sure you're going to learn a lot more in detail from the panel, and I'm going to request now Sugan to come forward and take the session forward. Thank you.
So before we see the report and the findings, I would like to invite on stage our esteemed panelists for the session. The session will be moderated by Jayashree Venkatesan, Research Director, Center for Financial Inclusion, Axion. And the panelists are Sugan Saxena, CEO, FinTech Association for Consumer Empowerment. We'll be joined online by Benny Chug, Research Manager, Dwara. Rahul Shashi, Cybersecurity Expert and Founder, Cloud SEK. Arvind Kodikal, Regional Manager, Asia Pacific Triple Jump. Suparno Bakchi, Chief Operating Officer, Balance Hero, India. We look forward to an insightful discussion. With this, I hand over the session to you.
Very warm welcome to all of you who have decided to come inside and listen to this important work in which we have put a lot of effort. So really appreciate all of you taking time to be part of this session. And most welcome to our panelists who have flown from different places. So really thank you to all. So what I will do in next 10 minutes is present a study, which is a high-level study in terms of what the risks are that we captured through our survey. Report is available both on CFI website as well as FACE website, and you can have a full access there. So just coming back to study. So obviously in this hall, there are people who are part of fintech, but there are people who are not part of fintech. I think it's very important to understand that fundamentally what the fintech industry is and how is it different from others. So one, I guess, is very important to understand because in inclusive finance, we have always seen very heavy physical infrastructure to reach underserved or unserved. Digital process allows us to go completely digital, right? So for our members, which are part of FACE and many others, I guess at least a couple of hundreds which are out there in the market, it's a completely digital process from where the customer starts the journey to close. So there's hardly any physical intervention which happens. Sometimes it would happen in some form through phones or other thing, but initially it's completely the customer who completes the journey. So in that sense, the digital trail is very, very important. Second important thing about this fintech lending is important to understand who the customer is. 30% or more than a third would be very new to credit or thin line customer. So fundamentally, we are still serving to the customer who are unserved or would have very small credit lines available from elsewhere. These are mostly low to mid income customer. We did a survey about 6 months back where we saw that 2/3 of these customers were actually earning less than 3 lakh individually, right? So these are actually very low income customers. Young, we all know. So to complete the journey through smartphone is mostly the young and sort of tech savvy customer who come for the digital lending, and but it could be both salaried and non-salaried. Both kind of people come. So given that persona of the customer who is coming to digital, they do come with their own vulnerability because they are early in their careers, their incomes would be less, it would be volatile, and also there's a lot of aspiration to fulfill, and convenience, the what they expect from the financial services. So this all sort of contribute to how lenders look at this segment, what kind of journeys they create, and which is very important. Third piece is, of course, all of you know, is data and technology is paramount. So this is something on which the entire business model is built. Other important facet which brings its own set of risk is lot of multiple digital players coming into the whole value chain through API integration, and therefore different partnership, whether it's terms of sourcing, debt recovery, KYC, fraud management. So that also, which is what the business model is, people work on their own competency, but it also creates own set of risks. And lastly, as Avtar said, it's rapidly fast-moving environment. What happens today may not happen tomorrow, so it's constantly changing because it's still very young. So models is still shaping in the way it should. So with this as a background, so are the risks. RBI working group report, for example, why it was formed was a precursor was what happened in 2019-20, where we saw a lot of illegal lending app completely, overwhelming the digital lending market space, and a lot of harsh recovery practices and so on, which came to forth. And then complaints are also coming, right? So 1/3 of the complaint come on these customer which are using illegal lending space. And then, so it's not one just illegal lending app, but even the legal lending app, there are issues around it. What data is being accessed, how it is being used, um, you know, uh, how do you ensure that it is a suitable product that you are offering and customer is not over leveraged. So there's a whole set of issues which are typical to any credit business. They do apply to fintech lending as well, and therefore RBI working group, I think it's a seminal work. Anybody who wants to understand what is happening, it's a 2-year report, old report, but it's still a Bible for us to understand how the different risks are emerging. So, and we are very fortunate to have Rahul, who was part of this working group report, to be there here with us, because it really tells you in very much detail that what those risks are. Uh, but when we, see this report, I think people still have a very this proverbial elephant view of risk, right? Somebody is looking at some risk, um, perhaps, and somebody is looking at other risks. You talk to stakeholders, people talk about risk in a very siloed way, and this is where we felt that there is a need for a more comprehensive assessment of risk, so that we can see, we can have a common speak for the risk for the industry as a whole, and therefore prioritize the risks which we can address fundamentally. Uh, so we had exchange with Jayashri very informally how we started. We felt that there is a clear need for this kind of study. We worked on the parameters of this study in terms of what we hear from the market. We tested the tool with some of the lenders, and then we launched this study. So for us as a phase, which is, all of you know, is an industry body for fintech lenders, uh, under creating an ecosystem which is safe and uh, robust for the customer is fundamental to our existence, and is part of our work to ensure that fintech lending evolve and matures and scales up in a way which is creating value for the customer and a lot of other stakeholders. So this risk is for us very core to identify what the risks are, and then we would take collective action to address them. So we had 23 risks which came on the which we asked people to respond on the scale of 1 to 7. So it's a perception of risk. Obviously, we are not saying that if some risk is coming, this actually is translating into risk, but it's what people feel the risks are. 40 companies responded to the risk. Some of them I see in the room. 30 lenders and 10 non-lenders. Non-lenders essentially include research bodies, think tank, investors. And so it was a response was collected after the digital lending guidelines have come in. So the backdrop was clear in terms of regulation, and we conducted interview to get more nuanced view of what people are saying, what it means. Um, so these were the top 10 risks identified by the fintech lenders from this report, obviously largely fintech lenders. I'll just pause here for 30 seconds for you to have a look what these risks are, and then I'll just go. Yeah. So now we'll go just deep dive. So one thing which was very clear is regardless of where you stand, top three risks were very common to which came out very strongly. One was this unscrupulous fintech lenders. You see both lenders and non-lenders um, ranking it very high and very severe. Similarly, cyber fraud and crime was something which came out very prominently. And third risk which we saw was the data privacy. So top five, these three risks were common across both lenders and non-lender community. Of course, for lenders, business risks are more prominent. So you will see funding, compliance, and regulation more prominently by lenders. For non-lenders, we saw that consumer risk, for example, unfair practices, transparency, leverage, was something which was ranked high. So in some sense, there's a different perception of risk also, because where do you stand? So now I'll just go one by one to some of these top risks. So unscrupulous fintech lenders. So who are these unscrupulous fintech lenders? So there is, I would say, two kind of categories into this, and it's changing very fast. We are working very closely on this. One is these so-called fake apps which would be cross-border, which come on the App Store, fake their relationship with any regulated entity, and take your contact details, start lending you, and use very strong arm tactics, very harmful tactic with the customer to take that money. So there's one set of these kind of institution. But as one of our respondents said, that scrupulous is not limited to illegal ones also. There are legitimate players in the market who might be doing practices which is not in line with, for example, RBI fair practices code. So this is something which is very critical, not just because it erodes the customer trust, but it cuts across different levels. So for lenders, it means less market, because you even now, if you can just go to Play Store and type loan app, there is a probability that out of 10 apps that you will see, at least 3 or 4 would be apps where the doubt is that they are dubious one. And the vector of this problem is moving very fast. So what you see as an app will change so fast. By the time we research, like for our reporting, we see by the evening it has changed. So it's a very fast moving vector, and that you have to keep completely monitoring it on an ongoing basis. Of course, it harms customer. And what we see is, once a customer has a bad experience with a digital lending app, she will never come back to digital lending. So perhaps we have lost that customer forever. And for our industry, there's so much talk about illegal lending apps. There's a lot of action which is happening from the enforcement agency. It also creates business risk for the legal one, right? Because when a customer commits suicide and there is an app which is there, so that illegal app will not be the only app. There would be other perhaps apps which are there, and then enforcement agencies obviously and rightly so would reach out to these apps. So it does create a lot of issues for the ecosystem as a whole, and that is why we saw unanimously lenders and non-lenders ranking it very high. Second thing which we saw was the cyber fraud. For me, this was like you could be dead, right? So this was something which doesn't happen perhaps as often, but the sheer impact is so high that all the lenders felt that this is something which they are constantly worried about, and we need much more robust ecosystem and tools to deal with it. Of course, from the lender's perspective, we see a lot of thefts around, a lot of risk around identity thefts. We see use of social media platforms, misusing names of the legal lenders. This is something which is happening. And Rahul is here. He'll give you a lot of information what else is happening on the cybercrime. So it's also very fast moving pace. Good news is there's much more coordination between government agencies, industry now on these pieces. And I think we should see a much coordinated effort in that direction. Third piece is data privacy. This came out largely because people felt that they don't know what they're collecting is good enough from the legal point of view. So when I say that, what they meant is the data. Fintech rely on huge number of data set. Lot of things, contacts, location, something which RBI has now said no, but there's a lot of other data points from the phones which come in. And if suddenly there is a understanding that this particular data point cannot be taken, it does disturb them a lot. And as a lender, you want to be sure that what you are doing is legal, so you don't want to get into the wrong side of the law. So from that perspective, it is important that data privacy law is underway, but something clear comes out. Third was compliance. Of course, this was the flavor when we interviewed people, and for obvious reason, because digital lending guidelines have come in. I think what it has done is clearly putting compliance to the fore, which was important. And but what we felt a lot from the lenders is interpretational issues and lack of channel to connect with the regulator to understand what has to be done. So not every regulation is 100% clear that, or black and white, that okay, you can do and you cannot do. So there are things which sometimes fall in between, and there are less avenues available for the industry to reach out to RBI and understand what their expectation is. So this feedback has gone to RBI. We are seeing much more interaction. So this is something which we felt is important. Not compliance per se, but the fact that you need better avenues to interact with the RBI. Unfair practices is something which obviously as industry, I think financial services industry is facing and has always faced. So this is not unique to digital lenders. But the sheer fact that even a small episode can snowball into a much larger thing is something which worries them, because then everybody is painted with the same brush. So that is why unfair practices came very high on the top to ensure that all the lenders follow similar practices, and that is where the role of SROs, which RBI has envisaged for the fintech lending industry, would be very important. Sixth point was regulation. Obviously, we have a digital lending regulation which came in September. So, but this is only the first step, and we have long way to go because there are a lot of things which will come. But there is a feeling from the industry that if regulations change too fast and too often without much clarity, it creates havoc the way business is conducted. So, and also investor and sentiment, because you need capital and debt all the time. So that was something which was very important from the regulation perspective, and also very strong feeling that regulation needs to understand fintech model a little more better, and therefore very close interaction with regulator and fintech is required, which at present is perhaps not as much. So that was something which was important. Um Data, of course, remains very core to fintech lending, is without which you can't do anything. What feedback we get why data is a risk is, of course, the privacy issue around it and what data you can take, but also so far the industry is really limited to the urban geographies, to a certain segment where the data is available. But if you go beyond that, there are still a lot of challenges in terms of data being available for underwriting purpose and other purposes. And therefore, how do we ensure that we have more data available which can help us contribute, do better underwriting, because that is the crux of it. And also there was a point which was coming out is data being so vital for the industry, enterprise risks which come because people change a lot in terms of jobs. Eighth was funding. It was very high by fintech lenders themselves. They ranked it third. I think a lot of people who are part of the fintech industry know that the debt fund which is available to fintechs is still very narrow, and therefore need to diversify the debt fund. Also, it's very high interest rate, which essentially means the cost of fintech lending is very high. And equity market, the people rely a lot on the equity, and which is volatile. So these were something which, from the long term sustainable perspective, is very important to have a much sound funding ecosystem, which can facilitate these startup new fintech companies to go forward, and clear paucity of long term patient capital, which I guess inclusive finance brings in, is something which is important. uh, Ninth was reputation. I think there is a extreme view of fintech lending, right? So sometimes it's just completely gungo view of fintech lending that it will change everything, and not. And then there is extreme view that it's all very bad fintech lending which is happening, which is harming customer and making them over indebted. But I think reality lies somewhere else, and this is something which lot of fintech lenders reported, that media stories or lot of narration around is very skewed, and what fintechs are doing in terms of even impact, in terms of product, in terms of diversity of customer segment, and the way they have brought the paradigm shift in the way we approach lending, it does not come out as clearly, so that was something which, and of course illegal lending apps, lot of noise around it impacts the reputation, so that they feel is important to be addressed, because once a customer feels that lending app is bad, it takes a whole lot of energy and investment to bring her back. So as an industry, I think for us, the thing is that we have, from our side also, we need to be much more transparent. I think there's hardly any data available for the fintech lending industry, which creates its own set of issues. Need forums like this where we can have opportunity to interact more often is important, because only by telling what you are doing, you can change the perception. 10th and the final one, which we are talking about, is a business model risk. I think this was an overhang of what happened in the last year in terms of PPI thing, but a lot of people felt that the way business model works, with lot of partnership, relies on some sort of regulation, how they look at it can completely kill the model, and this is something which we saw in the uh, card space last year. So I think that was very heavy on lenders' mind, that with one stroke or with one interpretation, the entire model can be killed. So that was on the risk side. In terms of opportunity, we also ask people what the opportunities are. These were obvious one, no brainer. Of course, we do know that there's a huge customer demand. There's no dearth of demand in this country. Short-term personal loan is something which nobody does, not even microfinance, banks, NBFC, nobody does. So there's a very clear demand for this kind of loan, which these fintechs are serving. And I'm sure they would go upscale and do secured and other kind of loans also. Growing digitalization is something which we saw in the last few discussion, and yesterday also on the mass market and other. The sheer wave of digitalization which is going through tier 2, tier 3, tier 4 city is just huge, right? So that is creating a lot of opportunity for data to come in, a lot of opportunity for people to have confidence in app lending companies, and this will drive further push for the fintech lending. And of course, we all know the positive environment from the policy side. There's no doubt that there's a huge, huge support from at a policy level for fintech India to make a fintech hub, or a bellwether of fintech lending and what else. So that is something which is very supportive. And we only have to do right things to translate this into business. So this was on the opportunity side. So I guess I'm done. Time? Yeah, we have time. Yeah. So in case people have any questions, I'm happy to take questions. Yeah. We have about a minute in case. Yeah. Yeah.
I just wanted to know that what were the regulations earlier and how they have changed now, and as you're saying, they're changing very frequently.
Yes.
So a little
Yeah.
more on
So
that.
yeah. So there was no digital lending guidelines available from the RBI. So people were sort of working in a NBFC kind of a framework where there are a lot of regulation, right? So there's FPC, there is outsourcing guidelines, there's IT assurance guidelines, and so on. So this is how people were working. Now with the digital lending guidelines, it came as a very focused, customer-focused guidelines, which clearly says that what you can do, which focuses on transparency, data protection, digital lending app, and the most important part of that is it sort of validates the relationship between RE and non-RE, which is called loan service provider, which a lot of these fintech companies are. So there is a, in some sense, recognition that these LSPs are very, very important part of digital lending ecosystem. So that was something which was very useful. So it has set the tone for the regulation. But if you look at the regulation, there are two annexures, 2 and 3 in regulation itself, which talk about a lot of things which will come in future, right? So for example, there's something which was very core to the business called FLDG. We don't know how it will shape. And that was very fundamental. I mean, it's very technical. I can talk to you later, but that was very fundamental to the model. Unless there's a clarity, market is headless chicken, don't know what to do, right? So that was something which was important. There was a product which PPI was used as a credit line, something which in August there was a communication from RBI which sort of clarified that you can't do this, right? So suddenly a lot of changes came. And then if you go to annexure 2, there are a lot of things which are parked in future, right? So what happens, it creates a uncertain business environment, because people say, okay, this much has come, but we don't know what will come tomorrow. So what I meant is there's a lot of changes which are coming, and not just in digital lending. You see there's a lot of changes in the IT Act, the IT infrastructure which RBI has put out in terms of draft. Credit card circular came, was updated. So a lot of these changes are coming, which of course take a lot of energy for compliances. And which obviously for any business, it needs a while for them to settle to new regulation and do things. So that is what I meant, yeah.
Thank you so much.
Uh, Hi, Sugandh. Good morning. Diptara from Ujjivan. I think it's an interesting presentation out there, and as a new bank who is trying to do something on the digital space, I think the regulation, like you rightly said, has kind of put a full stop to exploring partnerships. If I were to be that strong, in my opinion, because all of a sudden the space became so unsecure that the regulator has become insecure. And apparently what that has done is, I think they have put a lot of innovation at risk. And for us, so my question to you is, as and maybe to the entire panel, but what I'm looking forward to hear is, what kind of suggestions do you see? Because we know that there are risks out there, but when you want to take financial inclusion via partnerships, and it's not, a bank can't become a fintech unfortunately can't have the licenses that the bank has. So this partnership has to work out somewhere. So where do you see those regulations easing off so that it becomes a reality? FLDG and all, I would want to hear what you want to
I wish
suggest.
I could yeah, respond to that, but all I can say is that the sheer fact that LSP is defined in a certain way, of course, is very broad at this point. Uh, Itself tells you that you have a legitimacy of the model which works on the partnership. I think there's no doubt on that piece as such, but contours of that partnership and risk sharing, risk mitigation, risk ownership is something where I guess we as industry we also need to bring forth how it is happening to create a confidence or the trust for the regulator. So you will see a lot changing. It's not something which can happen overnight. So you will see a journey for all of us together to these things to shape. So, but I guess there are panelists who will talk a lot about this, what can be done. Yeah, thank you.
Thank you, Sugandh. And I think that was a great question to segue to the rest of the panel, because that hopefully will answer your question by the end. I represent the Center for Financial Inclusion, and we're delighted to be able to partner with FACE on this. Uh, I mean, for a number of reasons, right? Because India has seen so much innovation in both on the regulatory front as well as in terms of the digital rails. We think that digital lending holds tremendous promise, but it also runs the risk of eroding consumer trust, and we need to address that immediately. But also, there are several learnings for other parts of the world where we see the digital lending market emerging or evolving just as rapidly. I'd like to welcome our panelists again, and Beni, thank you for joining us online. Our panelists today bring a rich set of experiences. Just to start off, I mean, you heard all the risks that were presented by Sugandh. Do you have, I mean, each of you comes from, a different point of view, and I was wondering if you have any quick reactions to just the nature of risks. Is there something that resonated with you or stood out as, incorrect? Beni, maybe we can start with you.
Thanks, Jayashree. Hi, everybody. Really gutted to not be present in the room, but I'll try doing justice to my bit. Really nice presentation, Sugandh, and I think just my very first reaction is the kind of stark overlap between customer protection concerns and business concerns, right? I mean, unfortunately, sometimes the narrative is that business concerns and customer protection concerns are very kind of discrete and are disjointed in some sense, and therefore it's sometimes not good business to kind of worry about the customer. But I think the set of people that you've been able to speak to kind of dispel that myth, and I think barring the two about compliance and funding, 8 of them were actually pretty close to what hurts the customer. So to me, that's quite an insight. And the other thing that really stood out for me was the sheer fact that if registered, let's say, non-unscrupulous entities share the pains of the customer and kind of by extension share the pains of the regulator, then perhaps there's the bigger problem which is not present in this room, right? Which is out there, and which is what we also need to kind of be wary of. I think that what the RBI has done, and we'll perhaps discuss the merits and demerits of it in a bit more detail towards the second half, but what the RBI has done, from my very limited point of view, in my humble opinion, is kind of just chipping away at the tip of the iceberg when lots of kind of players are out there who are actually running with the intention of exploiting the customer. And I think we also need to be very deliberately focused on how do we kind of circle that square. So I think those are the two big takeaways from what you've shown, and I'm really happy to see 8 of those risks on the list of 10.
Great. Thank you, Beni. Suparna, maybe we can go in.
Sure. Firstly, thank you, Sugandh, for the presentation, and congratulations for the report. I think the report in itself, as you all have seen, right, talks about the various aspects of risk, right? You heard from Sugandh, it is not like an unidimensional approach of, let's say, one or two. Even the last one, or even that aspects of funding, it's like so important to take a spectrum view of the risk. But more importantly, what I'd like to focus on is the risk number one. And being participant to the research also, this risk number one, see, at the end of the day, fintech and more so digital lending, again to the question which you had, ma'am, is a sunrise industry. And in a sunrise industry, it's so important to handle things with care. And if you have players with a long tail, which are like fake apps or whichever way you call it, it poses a risk to the entire industry. And some of the risks which you see, be it be from a reputational standpoint, be it be from the apprehension of funding, alternate finance, everything, somewhere or the other sees a manifestation because of risk number one. So the risk number one, where we need to really separate the lemons out. Some of us have studied maybe back in our colleges and schools. This is what is the most important risk which we are going through. And I really appreciate the efforts being taken by the ecosystem, maybe to the large extent by the regulators, and again, associations like FACE working and trying to establish that kind of an intermediary, trying to establish that signaling that, hey, these are the ones possibly who are a little better off. But at the end of the day, it all starts with, again, awareness and what we are giving at the hand of the customers. Today, if you look at it, like, we want to validate the customers. There is a KYC, there is a digital identity for the customer. But just turn the table around. do we have a digital identity for ourselves so the customers knows that, hey, if you come to a True Balance app or if you go to a Credit B app, hey, this is the app which is authenticated, this is the app is the right one, not by just the show of the name, but actually it's the app. So I guess there is an opportunity for there as well, not just the ecosystem, but again with cyber and other experts thinking about solutions, leveraging technology so that the customer knows that this is the app, this is the identity. It's almost like going back to the brick and mortar world, and when we used to look at consumers and say like, hey, there is a ISI mark. So we don't have that mark, we need that mark, and we are kind of working towards it. So again, in summary, there is number one. If we address that, many of the other manifestations will be taken care of.
I wish we had a magic pill for that, but yes.
Just to add that, right? How many of the users here have a social media account, or are active in social media, right? And all of you guys have a mobile phone as well. Let me narrate you a real-world incident which happened. And this is my conversation. This happened to a doctor, a surgeon actually. One fine day, he got a friend request on Instagram from a lady, a profile looks like a lady. And then when she started updating status updates saying that she's doing trading. What trading? Crypto trading. So every day she posts status updates saying that she got this much return from the day trading, right? So now a curious guy, which he is, now he asks, hey, what is happening? How are you getting all this? So she responds back saying that I do crypto trading, and this is the crypto app, and it belongs to a famous lending crypto platform, right? Let's call it, Feb app, all right, whatever. So this is the crypto app I use for trading, and it's a legitimate crypto platform. So I use that for trading. So obviously he gets excited, he installs the app. Now she tells him that take $100 credit because this is your welcome kit. You can add this $100 to your account, and you can use that to start trading. So he does that as well, and he was able to make his first trading. So with the $100, he's able to now get $200. And she also tells him that at this particular time you have to do the trading, then only you will get the right amount of money back. Now that you got $100, $200, she encourages him to invest more money. So now he starts with 10,000 rupees, by the way, right? He starts with 10,000 rupees. Again, he gets certain returns when she does the trading at a particular point of time. Now the guy is excited. He puts all the money he has. He puts almost 46 lakhs in different tranches into the crypto app, which is on his phone right now. The minute he puts that much amount of money, the app, the person, everything disappears. Now can you tell me what just happened here? How, to the people who are thinking, the app which she made him install is not the trading app. It's not the legitimate app of the trading company. It's a fake app of the trading company. She and the gang created this fake app, which looks like a legitimate trading app, which will give you returns, and you can also withdraw money, by the way. And with that, what they're doing was, okay, why did they invest $100, right? You have to understand the ecosystem of cyber criminals are also changing. They are investing in you to get higher returns. But they spent $200 and got 43 lakhs. Now you think that this is a small group of people sitting in some place doing it. No, the FBI busted this gang. Now I'm going to go back how the cyber criminals operate to explain to you the scale at which this operated. By the way, this money was never recoverable, right? I mean, it's going into crypto, it goes into 10 different directions. You forget about the money. We couldn't do much about it. But when the FBI busted it, and this article is public, the lady who was acting like a lady were actually a team of 45 plus people, and these people were actually hijacked from Thailand, and they were people who were promised jobs from different parts of the world, who were brought to Thailand, and they were hijacked, kidnapped from Thailand, made to a remote location in an isolated forest sort of place, a big godown with internet facilities, where they were acting like farm animals who were scamming people around the world. Huge crypto scam. And again, you should go read this report about the FBI when they busted it. What was the situation of people who were doing it? So they were forced to scam people. So the point I'm trying to make is, first of all, the criminals are investing, right, to get high returns, which is why the number of fake apps and fake, fake, everything fake about this is growing, because the investment is huge. There are huge manpower which is going behind to get these returns. And they are making huge profits. Once they get profits, they're going to reinvest back into this system, because there's a huge demand. So everything you saw, the statistics we saw, is because of an ecosystem which is created, a parallel ecosystem which is being created, which is illegitimate, which is bad, which is actually creating a reputational damage for everything which is good, right? So for we as a company or together, it's very important to educate people about what is happening, to protect the good people as well as the good businesses from these bad practices out there, right? So that's all.
I'm going to come back to you on the consumer awareness piece, but Arvind.
Thank you. Yeah, from an international lender's perspective, I think the top 10 risks were very well articulated overall, and this is what we are seeing across various markets as well. So not a lot to add over there, and also I think my colleagues have spoken quite well. What was interesting for me to see, in particular on the funding side, was that paucity of funds is also an important element which comes about. And now I'm going to speak a little bit on myself and not put the entire international investment community on the block, but the challenge that we face is that we have to deploy funds across multiple markets, right? And then you're trying to build a framework or work on the basis of a certain framework or an architecture, and that's quite varied across various markets. I think India, in that sense, is fairly well developed compared to other spaces. But funders are traditionally conservative because the reputational risks are so high that a very small story over here can snowball into a massive issue for funders. And given that the kind of capital that's backing impact investments, especially at early stages, is government linked, has quite a lot of strings attached, for which we also need to answer to our stakeholders. That creates a chain of or it can trigger a big chain of questions, which we try to balance to some extent, right? So having identifying these risks, and I fully agree with, I think, the top 10 that were presented. I would maybe from my perspective sequence them a bit differently, but that's completely my perspective. um, uh, uh, I agree to those, and I think the path that maybe we should be taking, and in India, the regulator also is more amenable, because if you look at the whole microfinance development, right, the self-regulatory status that was given to Sadhan and then MFIN shows that the regulator wants to work with the people, but we shouldn't wait for some outside force to come and build these principles and incorporate them. I mean, you were asking a question about how can we have partnerships with the larger banking institutions and also build trust with the funders. If this kind of a framework could already be put in place, or elements of this can be articulated by the fintech companies in particular, that already allows us also to then take that step forward and see how can we provide funding. Because I'm not too concerned about the filters on how we choose companies, because we have very robust filters which can be translated from traditional impact firms into the digital lenders as well. But when it comes to cybersecurity assessments, when it comes to the more technical aspects, we are still trying to understand and cope with the changes that are happening in this space. And guidelines, policies over there are useful for us also to diligence, and beyond that as well, to further refine our own policies. So yeah, that's the lender's perspective. I'm happy to answer more questions that you may have.
Yeah, no, I mean, I definitely do think that the industry is at an interesting stage of evolution where, different stakeholders have to reflect and see what parts of their work needs to be updated in various ways. I mean, whether it's the due diligence criteria or the monitoring criteria. Um, I'm coming back to you, Rahul, because, one of the conundrums that we face in the inclusive finance industry is that at one end, tech obviously provides this massive opportunity for inclusion. And we've seen that during the pandemic, lots of people started paying digitally, one third of whom were new, according to Findex data. On the other hand, from the regulator supervisor point of view, you can only really tackle these risks. You can only tackle tech risks with very sophisticated tech tools. So what kind of subtech tools would we use on the one hand to identify some of these newer age cyber crimes that you're describing? And because it has to be real time at one end. And then how do we balance that with building consumer awareness for a segment of consumers that is not perhaps as digitally capable as we want them to be?
Yeah, hi. So from the monitoring perspective, right, I mean, while I was part of the RWA committee, and I think some of the statistics you showed came from, our research, we were able to identify at that point of time huge number of fake loan apps, right? And let me tell you one interesting thing. We identified an app called Cash Papa. Okay, Cash Papa was the name of the app. We don't know who was operating behind it, but we knew it was fake because it had no accreditation with any NBFC at all. The same company had another app called Cash Mama. They just changed the skeleton of the entire app, changed the name. It has two different names available in almost 30 different app stores. So you have to understand, Play Store is not the only place people can download apps from. Everyone in this room installs an app from Play Store because you are economically on a different scale. But you have to understand the people you lend to are not so rich, and they are always looking for free apps. And they can download free apps from these third-party app stores. So their primary source of installing apps are not Play Store, the third-party option, because that is where they can download apps which can give you free games. They can play free games. A lot of free things they can do there because they're all cracked apps, by the way. So that's where they consume the apps from. So we were able to identify Cash Papa and Cash Mapa in 30 different places, right? Which is installed in thousands of devices. And this is old data. Let me tell you the new data. Very recently, we have identified, and this is confirmed by different other departments as well, that there are almost 1,000+ variations of one particular company's app, and the company operates from China, right, targeting users in India with various different names. So you have to understand it's programmatically very easy to build a clone of a particular app, name it something different, and put it in a third-party app store. And what they were doing was investing huge amount of money in Google Ads to propagate this. So let's say you are a legit digital lending business. So you go to Google, which is the source of finding information. You search loan app, your ads are not going to come on the top. The 1,000 apps variations are going to come up because the amount of, so how did we track? We identified the Google ads have an ID. So you can actually reverse track and see how many ads are running out of this Google ads. So with that, we were able to identify all these other apps, right? So now the point is, how do you detect all these things, right? So if you're only monitoring for your brand and people creating fake apps in the name of your brand, that's not the only way to solve. Because how do you find Cash Papa and Cash Mama? Because they are still ruining your business, eating from the money you're ideally eventually supposed to get, and ruining the experience of the consumers. So you would need, and I think this is where my request to FACE would be to, right? I mean, to proactively not just look for the brands under you, but any cyber threat that can impact your consumers. So if you start looking from what is that threat that could impact my consumer, then what is the threat that will impact my brand, you could actually solve this problem. Because then you have a much more larger coverage depth and breadth, and you'd be able to find a lot more things that way. So that's my submission.
And Arvind, I'm going to turn to you only because, what you said triggered, it's almost like a global playbook that's being followed by digital lenders, right? So as somebody that's making global investments, are you picking up on some of these trends? And, is there almost a need to create this global dedupe mechanism? I don't know how we'll do that, but I'm dreaming, yeah, to verify. Is there what can we arrive at from just this modus operandi? Is there a way for investors to identify potential bad actors at a global level?
I mean, the answer is no, it's not easy. And each market has, like what's happening in India, for example, may not be happening in Uganda or in Kenya. Just because the regulators in those markets would say that every app has to go through a certain channel, right? So every country, from a regulatory standpoint and from the firewalls that they've created within their own countries, um, are operating at completely different levels. So therefore, I like to think of this more on some of the principles, right? And the 10 risks that we've articulated are actually you could, talk about them more as principles as well, right? And there's been some work that's been done by, say, IFC, and the kind of digital lending frameworks that have been created. I think the more teeth you provide to that, the more substance you can also provide within those frameworks. That will help us to bring a bit more structure to the conversations that we are having. It's in the same way, right, that regulations for banks are also quite different and varied across the markets. The same thing plays out in consumer protection as well, and the type of consumer protection that's required. Do we need to go to a European model as well with GDPR? I don't think so. I think that's going to really stop innovation in a lot of the emerging markets as well. So that's what my broad view is. What we are particularly as investors concerned about are, you know, bad actors, number one, who can create a reputational risk. But we believe that our screening mechanisms are adequate enough from a funding point of view. And maybe I'm taking a very limited scope over here, but we feel quite confident in being able to screen for and finance the good players that are out there. We are just starting to see what cybersecurity can do, and Rahul actually scared me so much even before the session as we came in, because what you don't know, and now unfortunately I know, and there's very little that I can do about it. So, but it's good to be aware of cybersecurity, because in one of the companies which is in our portfolio, we saw that because of a ransomware attack, and I was discussing it with him, all lending stopped for about 15 to 20 days, which then impacts the credit quality of this institution, impacts the reputation as well, which is a big, a cause for concern for financiers like ourselves. And then consumer protection and the kind of data scraping that's happening within the fintech world. That's another important area where every region that we operate in has a different set of principles and ethics with which they scrape data, maintain data, and utilize that data. So we would like to see some standard principles being agreed to. And as a matter of fact, even in the developed markets, we don't have a unified language with which we are speaking, right? The Americans have a different view about data privacy than what the Europeans do. So, yeah, very difficult conversations. I don't think that there are any easy answers, unfortunately, especially not from a financier who are by nature very conservative and not as knowledgeable. But yeah, those are the perspectives that I can talk about, things that we are actively working on.
No, I'm glad that you brought up the ransomware example, because one of the things that Sugandh and I discovered when we did the survey and we analyzed the findings is governance actually ranked as a fairly low risk So when you read the report, you'd find that it's, right at the bottom of that list of 23. And we think that, governance is quite closely linked to thinking about business continuity plans. It's quite close to, thinking about processes that one needs to put in place. Even things like cybersecurity patches and how quickly are you doing that. So Suparna, turning to you, because you think about entrepreneurship and you think about governance so
Right.
much. Um, why do you think it was a low risk, and how can we build awareness to say that, look, these are all interrelated in some way? Um,
Sure. I think, Yashri, it's a it's a great indication in terms of taking a note of things, right? When you go through such kind of research, when you kind of publish the report, it's also a reflection point for the industry players themselves. The fact that governance risk is somewhere little lower on the spectrum is a note to be taken by the players. Uh, and to be honest, like, it's actually a lot higher and lot higher in terms of a consideration. If you look at it, and going back to even what Arvind was also mentioning, right? Now, governance risk is not just about, let's say, data control, and those kind of things, but governance risk is a lot more holistic, especially in the fintech space, especially when things like the regulated entity is at the forefront of driving business, right? It also transcends to facts like even ESG, the reference to the conversation which Arvind was having, right? So if you see today, we are having conversations even from a funding standpoint. We want like the alternate vehicles to come in, and then on the other side of the table, there is conversations around like, hey, who's on your board? Do you have a woman on the board? Do you have like independent directors? So it's an evolving space, and I think more and more players also get into those kind of interfaces. They will also start appreciating that, hey, there are certain mechanisms which needs to be addressed in a different scale and in a different light of governance, and therefore being able to maybe address to some of the concerns, be it be open up vehicles around funding, or be it be even things like where the ecosystem is a lot more appreciative of the efforts which the players are taking. Thus far, by and large, the psyche of the industry has been built in the sense like, okay, what's the next app, what's the next solution, what's the next app journey? So that has been the psyche, but it's a journey and it's an evolution. And I'm sure like next time, maybe when we do a similar exercise, you will potentially see the governance risk and the appreciation towards it a little on the higher side.
Yeah, fingers crossed. And I think Sugandh has her job cut out here. Beni, I want to turn to you because, you mentioned something quite important, which is, where the current RBI regulations have steered the industry. But you've been thinking about, consumer protection at a larger scale and written extensively about just the need to rehaul regulation. And I think that might answer our colleague's question earlier about partnerships and what that might mean. So I was wondering if you can tell us a little bit about what are the gaps that you think we need to address as far as just the regulatory frameworks are concerned, and thinking about the evolution of the sector.
I think a lot of what I'll say will draw from a lot which is already said, but perhaps I'll be able to structure it in a slightly tighter form. Just pulling back from what all of you've said already. I think the one bigger piece, which unfortunately is out of the ambit of the RBI, is the whole part about unscrupulous lenders who are not registered with the RBI. And I think that placing that in Annexure 3 or 2, I forget which one, but to kind of say that this is for later is kind of an ongoing customer protection risk. As someone who thinks about low income, new to digital finance customers, that causes me anxiety. So I think that one is for law enforcement agencies and the government to take up as soon as possible. Now, coming back to the RBI ecosystem, I think there were a couple of big gaps, right? Big gaps, you can broadly call them data protection, but there were like very nuanced dimensions to each of that. One was just the data being collected and the protection that was being afforded to that data, the clarity of data ownership. Let's say if the third party is collecting it, if the regulated entity is collecting it, whom does the buck stop with? Broadly, under the outsourcing guidelines, we do know that the buck always stops with the regulated entity. But what is it that the regulated entity should be demanding of its players? I think that has kind of become more clear. Even the kind of carving out a very, I want to say, guarded space for expanding the scope to pink credit bureau reports, for instance, expanding it, but at the same time keeping it within licensed entities so that the RBI has enough stick and levers over them. I think all of those are quite welcome, especially because the data protection bill journey has been a long drawn one, and we still don't have clarity over where it's going. So that one was quite welcome, and I think the way the RBI has gone ahead and done, at least in principle, is great. I do hear from our partners that there's a lot of kind of long journey that they have to take in terms of bringing their third party vendors at par. The platforms that they use are different, data sharing mechanisms are different, just data mapping is kind of if I can say, a harrowing experience. So I do appreciate that learning curve that all of us will have to take. But in principle, I think they did hit the bullseye when they spoke about data protection. In some other cases, I think the reaction has been more in terms of less principled and more in terms of solving for the narrow use case. And I think that's where a lot can be done better and more. For instance, defining LSPs is great, but then the moment we read the LSP definition, we see the overlap with the BC definition. And then we are confused that, which kind of, and I don't know if this is a confusion that other people share. I'd be happy to kind of hear about that as well. But there's so much overlap. So can we now finally think and imagine, as someone said from Ujjain earlier, that the future of financial inclusion is partnered, right? It has become a commoditized value chain. It will become even more so, and we have to appreciate that there's going to be a lot of hand holding and handshakes across the value chain. So I think there's now room for creating that umbrella framework for what a third party unregulated entity is expected to do by the RBI. And I think that clarity, that articulation, that bigger vision is what would give more clarity and direction to the industry as a whole, as opposed to defining entities every time we come across a use case. I think that's the need of the hour. And I know we're kind of short on time, so I'll just kind of wrap up with the FLDG
You
point.
have time, don't worry.
Okay, great. Thank you. Then please bear with me. So just on the FLDG point, right? Significant confusion, and I do understand that players are still kind of seeking clarity even today from the RBI as to whether it's permissible, whether it's impermissible. I don't know if internally there's greater kind of visibility over the status, but at least that's what we are hearing. And there again, I thought that the concerns of the RBI are not unwarranted, to say the least, right? I mean, there's a real concern that this is off balance sheet commitment, and nobody can kind of vouch for the strength of the balance sheet of the entity offering the FLDG. But I thought that there were more polished, more nuanced ways to kind of shed visibility, increase transparency around FLDG arrangements, bring them within the institutional kind of arrangements, as opposed to kind of just banning them altogether, because that has served us well in the microfinance space. Circumstances were slightly different in that both entities were regulated entities, and therefore the RBI had some confidence in the balance sheet. But I think even today there's scope to kind of create transparency around a limited access registry of FLDGs being offered by different entities, so that the regulator has enough confidence, even the parties contracting have enough confidence in each other's ability to come through. And I think so there's like more nuance that can be added. A risk proportionate regulation of FLDG as opposed to a complete ban is something that could perhaps give the sector the confidence, as well as the kind of liquidity that it needs to kind of exhibit skill and signal each other's credibility. So I think that one was important. And then just on the supervision thing, so I think Rahul spoke about one aspect of things, and then there was this other aspect which was said about that how do I as a customer identify a bona fide digital player, right? I mean, that's what it is boiling down to today. And I think that there's this whole other kind of subtext that can happen in the vein of market monitoring that can really kind of then come to not only the customer's rescue, but also the RBI's rescue, right? So market monitoring through Twitter analysis, market monitoring through real-time grievance redress analysis, market monitoring through creating agencies dedicated to supervision, using AI, having the capabilities. Currently, the regulator is far too stretched, right? And therefore, we perhaps need a department which is solely, or perhaps even a body which is solely focused on supervision. And I mean, it's not every day that you can crack a case like the FBI case, right? You need to have like dedicated bandwidth to even unearth cottage industries of frauds going out there. And we know that it is at that level, at least, if not a bigger level. So I think there's more kind of one expectation that we did have of the guidelines, which did not come through. But I think from Sugand's comments, it seems like it's underway, is a greater or more clarity on an institutional framework as to how the law enforcement agencies, the different regulators in the financial sector, as well as new stakeholders, right? So 30 app platforms, is what I understood from the report, or perhaps more. So these entities, unfortunately, are vectors and will have to kind of step up to the roles that they create for themselves in this new, safer digital environment, right? And finance is just one thing, but tomorrow, even for health apps, we're going to see the same risks all over again. So there's time to kind of understand who the new stakeholders in this digital ecosystem are and be innovative, as much innovative about regulation as we are about business models, right? If business models cannot leave out new agile entities, nor can regulatory kind of frameworks. And in all of this, we understand that we're moving to a more coalesced, less siloed financial ecosystem, and therefore, so should the customer protection framework. So, unified grievance redress. I mean, today account aggregators can actually transfer data from insurers, from GSTN to my, fintech provider. But if there is some error, who do I go to? Do I go to my insurer, which is like a completely different grievance redress mechanism? Do I go to my account aggregator, or do I tomorrow go to the DPDP? So I think there's kind of more coordination that is needed across regulators, financial and otherwise, and more kind of unified grievance redress channels, because the customer should not be running pillar to post, right? Today I borrow money, the money comes via NPCI, I face a payment failure. I don't know if I go to the TPAP, if I go to the lender, if I go to the NPCI. So I think we have to understand the real challenges. It seems seamless because it's happening via a screen, but at the back end, everything is still very much siloed and disjointed. And once you kind of go beneath the top layer, if as a customer you have to ever experience that, there's a lot of opacity and a lot of friction. So I think these are some of the things that we'd like, future iterations to focus on.
It's a great point. I do worry about how this seems sometimes like you're building an aeroplane while trying to fly it, because it is that we don't have good grievance redressal mechanisms. One of the reasons why we see this vast set of complaints on social media is because there isn't any other channel. But anyway, that leads us to the last question. But before I go there, I want to make sure that our audience has the time to ask questions. Is there, is there anybody that has a burning question that you want to ask our panelists? I can't see because the light is in my eyes. So no. Okay. But I do. So Beni raised an important.
Sorry, Jayashree. Here, Suparno.
Oh, yeah.
Yeah, sorry, if I may add just a couple of things onto what was said, primarily on the FLDG part of it. See, I guess one thing for sure, number one, all of us need to appreciate is what this digital lending guideline has done, is actually taken the conversation to this room.
That's true.
Yeah, we are not yet there on FLDG. It's still a journey, and it is going to be fundamental to the industry for sure. But again, we need to really, really appreciate that. I have been part of conversations 6-7 months back in time, where possibly this was the elephant in the room no one wanted to talk about. So for various reasons, various apprehensions, securities, insecurities, everything put together. But that's number one. I think we all need to kind of acknowledge that this has, again, thanks to the regulators, thanks to everyone working together. And the other part of it is like, how do we really approach? FLDG is one side of it. There are a few other fundamental aspects. I guess somewhere the fundamental problem, Jayashree, what's happening is we are trying to approach it like a jigsaw puzzle, right? So in a jigsaw, you know what the solution is going to be. You have few parts and you're just trying to fit in. But then the other side of it is like you have blocks and you want to build together. And I think that's where, again, it's very, very important, not just the players, but in terms of intermediaries coming together, and Annexure 2, Annexure 3, everything is an outcome of a dialogue. With all due respect, possibly that's where the time is taking. So I just wanted to add these 2 points.
That's great. I do agree, and thank you for weighing in on that. The thing that worries me and keeps me awake is that as we move towards, you just pointed out how you have to go to already different stakeholders to, sort out issues. As we move towards a future where embedded financial services are the future, and you're bundling financial and non-financial services. I worry about the number of risks that we'll see I worry about just the consumer protection issues that might arise and the regulatory gaps that might arise that we need to address now. And I was wondering if you can, weigh in on that as panelists. And the one thing I didn't say is feel free to contradict each other at this point.
Um, Interesting times. See, as a build person, right, or even with all the entrepreneurs, uh, you are motivated primarily with a purpose, and purpose, I guess, is a function of two M's, right? Do you have a meaning, and do you have a market? In the sense, like, are you doing something which is deep enough to add value to the customer, and are you able to do it at scale? Now, if you put this lens, no other better place than fintech. Now, so that's one side of it. But then again, I guess we all as players and we all as entrepreneurs and leaders and everyone put together, we need to understand there is a fundamental difference between some of the other sectors, be it be an internet economy of e-commerce or healthcare, and vis-a-vis finance and fintech. Fundamentally, there is an aspect of regulations, and if you don't appreciate when building products, when actually at the stage of ideation, we will always see regulation as like a speed bump. Whereas, again, thanks to maybe my enterprise background of 20 years, whereas regulation is actually a guide rail. So fundamentally, as we get excited about fintech, our opportunity to kind of add value and make purpose out of it, it is very important to understand that it's not a binary. It's not like the regulations on the other side. It's more like it's more like a guide rail, and how we are able to early engage even from the stage of inception when we are thinking about a product, what it means. A clarity aspect is very, very important, but I think like till the time we are wired in our head that this is the way we need to kind of go for it, I guess we are okay. I mean, personally, I'm a Spider-Man fan, so the way I look at it, with great power comes great responsibility. That applies for fintech. Thank you.
From a lender's perspective and from a shareholder's perspective, I truly appreciate that we're trying to solve problems, and sometimes entrepreneurs, they see that, I mean, if you talk about embedded models, right, in ag tech as well, what we are seeing is that financing credit is the bigger problem, right? So there's natural ambition to go towards that. From lenders' perspective, however, we want to see some internal walls being created, because naturally what tends to happen is that conflicts will arise, right? If you're an embedded finance player, and you're trying to solve fundamentally different problems. The overall you want to solve through for the life cycle of the, or let's say, uh, the bigger problem has multiple components to it, let me put it that way, and finance is a very critical component, credit is a very critical component, which can ease the other components as well. But from a risk management perspective, they are quite unique, right? They're on the opposite ends of the spectrum as well, and therefore having those guardrails, those chains, those walls becomes really important. That's something that we want to observe more carefully, and therefore, as a financier, for me, it's easier to look at partnerships versus embedded models, because I know that in a partnership, each side naturally has its own firewall kind of created. And an embedded model, where does the sales stop, where does risk get managed, and what happens to the client overall, who is now dependent for on the source of income, and also, let's say, on lending with the same party, who will try to extract the maximum amount of value and do risk management maybe in a different way, right? Those are the risks that we try to. I'm not saying that again everyone is building their companies in a way that's unfair, but these natural challenges will happen, and I would like to see those firewalls in place, and that's what's happening in our diligence process as well. These are the conversations that we are trying to work with. So yeah, I may not have articulated that very well, because this is a new conversation for us as well, in embedded finance, but that's a direction that we'll likely go towards. And sorry, we are just very conservative by nature, right? So
Yeah, I mean, I'll take a minute to do a little bit of education on something we have launched recently, and this is very important for you. As a consumer, you would have tons of mobile apps on your phone, right? Whether it's a loan app or not, whatever. You do not know the security of these mobile apps. When I say security of these mobile apps, each of these apps are taking some amount of data from your phone. Some of them have access to your gallery. Some of them have access to your contacts, images, SMS, emails. We have launched a free tool called BVigil, right? Cloud Check BVigil. You can search on App Store. It'll sit on your phone and tell you all the apps that are on your phone and the security rating of each of those apps. We're also planning to embed the system, which will also tell you whether the app is legitimate or not. But at this point of time, it'll give you the security score, and it'll also tell you why it is rated low. For example, this app, which has access to your gallery and is pulling all the data to their cloud, has poor infrastructure security, which will eventually lead to all your gallery images leaking on the public. It'll tell you very specifically that. So I just wanted to educate, because that's our way of pushing cybersecurity forward and making better consumer protection. So wanted to share that.
That's I did look at the app, so I thank you for that. Beni, any last thoughts on this?
Yeah, I suppose if I had a wish list, it would be more concerted ex-ante supervision so that we're able to detect customer issues as early on as possible. Some of the infrastructural innovations, for instance, the app that we just heard about, if they can be made standard playbook material, and the onus of operating them, as much as I appreciate it, but the onus of operating, downloading those apps, if in some way can be shifted from the customer to, let's say, a Play Store provider, right? Where at the time of kind of downloading the app, the customer is getting a notification. This is not to in any way take away from what's being done, but to say that when we think of low income, less literate, bandwidth constrained customers, we have to be very proactive in kind of internalizing protection initiatives. So more proactive ex-ante supervision, more ex-ante measures for cybersecurity, internalizing customer protection gaps before they kind of manifest. And in my opinion, this also means that greater clarity on the regulatory side, a more participative regulation, because if gaps in the regulated entities will obviously manifest in customer protection gaps, and should grievances still occur, which they will, which is not a kind of reflection of anything going on in the ecosystem. For the most part of the ecosystem has done great ex-ante work. Should grievances still occur, then the grievance redress procedure should be as seamless, and the customer delight quotient, which I've learned from Sugandh, should be as high as that of onboarding, right? A grievance redress cannot be an afterthought, and I think we have to kind of start worrying about what are we leaving the customer with, because that has a huge implication for the overall reputation of the sector.
Yeah. No, thank you. People have been signaling that we're running out of time. So I'd like to thank all the panelists. I think this was great. We are definitely left with a set of open questions that we need to work together to address. But, this is an interesting sector, and I think it is our responsibility to do right by the consumers that we want to serve. A huge thank you to Face again for this opportunity to partner with you. And thank you for your time. And the audience, thank you.
Thank you.
Thank you, Beni.
Thank you, panelists who have been part of the session in person and online. As a token of our appreciation, please accept our souvenirs and a photograph.